This is Kenny Tan. Welcome to Real Estate License in 14 Weeks. This is episode 21 of Starting from Zero. We continue to talk about financing in chapter 6. If you like my video, please give me a thumbs up, subscribe to my channel, hit the bell, and share my video with your friends. That way you receive first notification of my new releases of my video. What is Truth in Lending Act? Truth in Lending Act is also known as Regulation Z. So for exam purposes, please remember Regulation Z is the same thing as Truth in Lending Act. I assure you one of the questions might be asking about Regulation Z. So it is a federal law intended to protect the consumers. So whenever there is a loan transaction involving a consumer, there are certain information about the loan that have to be disclosed as put together in a Truth in Lending disclosure. There are 4 pieces of information that should be on the disclosure. Number 1 is the amount financed. Number 2, the finance charge. Number 3, the annual percentage rate, also known as the APR. And number 4, the total number of payments. The second important aspect of a Truth in Lending Act has to do with the advertising of mortgages or loans. The advertisement must be clear and conspicuous. In other words, the advertising cannot be misleading. So if an advertiser advertises certain information about the loan, the information must be complete, such as all the different costs associated with the loan, the finance, the interest rate, the mortgage insurance, and so forth. However, if the advertisement discloses the annual percentage rate, if the annual percentage rate is advertised on the advertisement, is stated in the advertisement, that is all that is needed for the loan to be complete, the advertisement to complete. So, and it's quite often tested in the exam, is that if the annual percentage rate, the APR, is disclosed, that is a complete disclosure. Earlier I talked about finance charge. So exactly what is a finance charge? Finance charge is just the total cost in dollars, which includes the points, the loan fees, the mortgage insurance credit report. All these charges are all classified as finance charge. So what is an annual percentage rate, otherwise known as APR? It is an expression of the total cost associated with the loan, but expressed in terms of APR, expressed in terms of a percentage. See, every time when you go to the bank, after you're finished with the teller, as you walk out the bank, on the left-hand side or right-hand side, you might be seeing some advertisement by the bank concerning the loans that they carry. Oftentimes, you will see the APR number. That is what we call APR. It is total cost of the loan expressed in terms of percentage. Just remember, as long as the APR is disclosed, that is enough to educate the consumer as far as which loan is a better loan in terms of the cost. It is easier for a consumer to just kind of look at the APR and immediately know which one is a lower cost loan. For example, if an APR is 4.1, and then another one is 4.2 and 4.3. Obviously, for the consumer, it's an easy choice because the 4.1 is the one with the lower cost. And as far as picking the right loan and the lowest interest rate, the consumer will pick the 4.1 because all he needs to do is just look at the APR. Makes it a lot easier for the consumer. Next, when does the consumer need to receive the disclosure about the terms of the loan? The timing is that the disclosure must be given to the consumer before the consummation. What does consummation mean? Consummation means the signing of the loan docs by the consumer. It could be an exam question, so consummation is a very important word, remember that. It means the disclosure about truth in lending must be provided to the consumer before the consumer signs the loan docs. So how much time does the consumer have to change his mind about the loan once the disclosure has been received? The consumer has exactly 3 business days to change his mind about getting that loan. In other words, he has 3 business days to make a decision about whether he's going to accept the terms of the loan or not. Who enforces the Truth in Lending Act? In other words, if a lender violates the Truth in Lending Act, which governmental law office actually enforces? They will go after the lender for violation of the Truth in Lending Act. The governmental branch that is responsible for the enforcement is the Federal Trade Commission, otherwise known as the FTC, Federal Trade Commission. How does a borrower get qualified for a loan? That's called qualifying the borrower. Obviously, one of the things that the lender will look at is the borrower's ability to pay. The borrower's ability to pay is examined just by looking at the FICO score. So for exam purposes, the borrower's credit score determines the borrower's ability to pay. But if you just look at a borrower's credit score, let's say a borrower has a credit score of 800, but he has $0 in his bank balance. But the $0 in his bank balance doesn't say anything about his ability to pay. Ability to pay, you just look at the FICO score. But you cannot just look at a borrower's FICO score and decide that he qualifies for the loan. There are other things you need to look at. For example, if he makes only $1,000 a month and he's trying to qualify for a purchase price of $1 million, you know that doesn't work. So the income would have to be looked at in terms of the amount of the loan and in terms of the purchase price. On top of that, even if he meets the income requirement in terms of the loan and the purchase price, the lender also needs to look at the appraised value of the property. Why does the lender need to look at the appraised value of the property? Because you know what? The lender doesn't want to lose money. If the property is only appraised for $350,000, and the borrower is trying to qualify for $400,000. So obviously, there is significant risk to the lender if the lender goes ahead and approves the loan. The appraised value would have to be either higher or equal to the purchase price. Let's say the purchase price is $400,000. Appraisal came back at $350,000. In this case, the borrower would have to bring in the additional money to make up that $50,000 shortfall. And also, title insurance is important too, because a lender doesn't want to take a risk, take a chance on a property where title is going to be a problem. The lender wants to be safe. Ultimately, the most important assurance that the lender has is the appreciation potential of a property. In the down market, when the market is in the downward trend, the lender is going to require the borrower to bring in more down payment because there is significant risk that the lender may lose money if there's not enough equity of the property. So appreciation is the most important assurance or security that a lender has. So remember, there might be an exam question on the issue of appreciation. Appreciation in value of the property is the most important assurance and security that a lender has. The next concept we're going to talk about is impound. So what exactly is impound? An impound is just a reserve that the bank wants certain borrowers to have on their loan. For example, if a borrower doesn't pay his property taxes or doesn't pay his insurance, it puts the lender at risk. If a borrower doesn't pay property taxes, then the county government might put a lien against the property and then ultimately sell the property at a tax sale, and the lender will lose their interest. So certainly the lender wants to make sure that the borrower pays the property taxes. And insurance, the same thing, because if the house burns down in a fire and there's no insurance, it puts the lender at risk. So taxes and insurance are the two most important expenses that the lender want to make sure that the borrower has, or at least set aside as reserve. And impound is just additional money. Let's say, for example, the property tax is $10,000 a year. So what the lender is going to do is, the lender is going to require the borrower put in additional of 1/12 of $10,000 toward the payment of the property taxes. And then let's say the insurance, the property insurance is $1,000. Each month, the borrower will be required to send in 1/12 of that $1,000 toward the escrow account. There will be an escrow account where the money is kept. So in other words, the lender in an impound situation, the lender does not charge the borrower extra for the impound, but rather the lender will collect the money for the taxes and the insurance, and then the lender will be responsible for paying the insurance and the taxes. That's how an impound works. Not every single loan is subject to impound. Generally speaking, loans that have less than 10% in down payment, in other words, they have higher than 90% in loan-to-value ratio. 90% loan-to-value ratio means that the borrower only puts in 10% down payment. Loan that has greater than 90% LTV, loan-to-value ratio, or the borrower puts less than 10% in the down payment, will subject to the impound that I talked about. There could be another situation where the borrower might be required to put an impound, such as when the borrower was in default of the property tax payments by 2 consecutive installments. Those are the 2 common situations. The concept of points. What is point? Sometimes when you get a loan, most borrower will want a loan that has no points, no fees. What is point? Point is a certain percentage a lender would charge for originating a loan, for example, for putting the loan together, the paperwork and everything. We call that origination fee, which is expressed in terms of point. If a loan of $400,000 where the lender charges 1 point, that would mean that the borrower will pay $4,000 toward the origination fee, if the origination fee is expressed in terms of 1 point. Another situation where point might be used is called the discount points. Discount points is different from origination fee because discount points are points that the borrower pay to lower the interest rate. For example, if the interest rate might be 4.5%, however, if the borrower cannot qualify for the 4.5%, but the borrower can qualify for, let's say, 4% or 4.25%. So an option to the borrower will be to pay points to the lender to lower the 4.5 to 4.25 or 4. This is called the buy down. Buy down means what? You pay points to the lender to lower the interest rate. That's called a buy down, and that's also called the discount point. What is private mortgage insurance? In the case of a conventional loan, the last time we talked about Freddie Mac. Freddie Mac handles conventional loans. So if a borrower defaults on a conventional loan, there is no governmental insurance. You don't have situation like FHA or VA where the government insures the loan. So what does the lender do to feel comfortable about making loans to certain borrowers? PMI is more common where the percentage of the down payment is less than 20%. If it's less than 20%, most likely most lenders will require the borrower to purchase some kind of private mortgage insurance. The purpose of the private mortgage insurance is to protect the lender and make sure that the lender gets paid if the borrower defaults on the loan. This is the end of episode 21. See you next time.